Today, I'm going to break down liquidity in extreme detail, helping you to enter trades alongside the big players and avoid unnecessary losses in the markets. After helping hundreds of students worldwide be profitable, I'll also simplify the 3 types of liquidity that you need to understand, which isn't as complex as people make it out. Once you understand liquidity, you'll be able to boost your win rate, bank consistent profits, and take trades with clear targets. Liquidity refers to the orders in the markets, and it's where a majority of retail stop losses are sitting. Remember, markets move due to orders, money, and transactions taking place and passing hands. Imagine a big swimming pool filled with water. The more water there is, the easier it is to swim, right? And that's similar to market liquidity. It's how easy we can buy or sell something without causing big waves in price. And remember, it's the big players like banks and institutions that actually move the markets, not everyday retail traders. To understand liquidity, think about where people are generally buying and selling from, usually around swing lows and swing highs. Below swing lows, there are stop losses of buyers, but also sell stops of breakout traders who are trying to short the breakdown to the downside. Above swing highs, there are stop losses of sellers, but also buy stops of breakout traders who are trying to long the breakout to the upside. And so there are a cluster of stop losses above the swing highs and swing lows, forming liquidity. And these liquidity pools act as a magnet for price to target. Markets are more likely to react significantly at these liquidity zones rather than random mid-range levels, as most of the orders are situated around swing highs and swing lows. Price might hit the liquidity above the swing high, taking out the stop losses of retail traders, and then continue lower down, taking out the liquidity below the swing low, before finally then pushing up. Remember, liquidity is simply the market reacting to where majority of the orders are situated, and these liquidity zones act as a magnet for price. Markets are constantly flowing between them. Liquidity is likely to form around support and resistance levels too, as many retail traders are using them. Retail traders aim to buy at support, and so there's going to be a cluster of stop losses below. There's also going to be sell stops as breakout traders are trying to short the breakdown to the downside. Retail traders aim to sell resistance, and so there's going to be a cluster of stop losses above, and also buy stops as breakout traders aim to long the breakout to the upside. And so there's liquidity above support and resistance levels, which act as a magnet for price. So once liquidity to the upside has been swept, you can look for a short and aim for liquidity to the downside. Now that you understand what liquidity is, let's look at the 3 common types of liquidity. First up is equal highs and equal lows. Mass market trading education teaches outdated methods of trading, like double tops meaning a price will reverse, or double bottoms meaning a strong support. It sounds smart, right? But here's the catch. Many everyday retail traders are using them, and when everyone uses the same pattern, it becomes obvious. And big banks and institutions see this and take out the stop losses of retail traders. Equal highs form when the market forms similar highs viewed by retail traders as strong resistance levels. However, there's a cluster of stop losses above, which act as resting liquidity. And what happens in real life? Well, price takes out the stop losses of retail traders before then continuing in the initial intended direction. Let's look at an example of equal high liquidity using this euro-dollar chart. As you can see, price formed similar highs here, forming equal highs. There's going to be a cluster of stop losses above, which act as a magnet for price to target. So let's see what happened next. As you can see, price had an impulsive move down, and then price had this impulsive move up, which took out the stop losses above the equal highs, clearing the liquidity. And this just shows you that these principles of liquidity hold true in real market conditions. Similarly, equal lows form when the market forms similar lows viewed by retail traders as strong support levels. Especially as traditional education teaches that this is a double bottom. But again, this is liquidity. And smart money take out the stop losses of retail traders, fill in their positions, and the pricing continues in the initial intended direction. Let's look at an example of equal low liquidity using this Australian dollar chart. As you can see, price formed similar lows here, forming equal lows, and there's going to be a cluster of stop losses below these lows, which act as a magnet for price to target. And we want to get in after the liquidity has been swept, as we can anticipate a reversal. And this is important to understand to avoid stop loss hunts, which are the tagging of retail trader stop losses. So let's see what happened next. As you can see, price pushed much lower down, taking out the stop losses of retail traders below the equal lows, clearing liquidity as well. And then we have this reversal. This is an example of a stop loss hunt. Now that the liquidity to the downside has been cleared, we can enter a long trade and aim for liquidity much further up. And in terms of profit target, we can aim for these equal highs here, as there's going to be a cluster of stop losses above. So let's see what happened next. Price would have pushed up, making our long trade in significant profit, and then we actually managed to clear the equal high liquidity as well, taking out the stop losses of retail traders. And so in this example, price took out the liquidity to the downside, clearing the equal low liquidity, and then it was attracted to the equal high liquidity, showing both equal low and equal high liquidity principles in action. Now that you've mastered equal high and equal low liquidity, let's move on to trendline liquidity. Traditional mass market education teaches retail traders to wait for 3 touch points and to draw trend lines or support and resistance levels. But smart money know retail traders are doing this. And what happens in real life? Price takes out the stop losses of retail traders and then moves in the initial intended direction. Now let's look at an example of trendline liquidity using this chart. As you can see, we have 3 successive lows which can be connected by a trend line. And this is trendline liquidity. And many retail traders are aiming to enter long here, putting the stop losses below the lows, forming liquidity pools, which are targeted by big players like institutions and banks. So let's see what happens next. Price takes out the stop losses of retail traders and then continues in the intended direction. Many retail traders also draw trend lines like this and subscribe to the idea that only once a trend line has been crossed is there a change in trend. And once crossed, they aim to buy on retest. But this really just becomes a context for liquidity, as there are sellers looking to short the downtrend and breakout traders aiming to catch a long. However, a trendline break does not mean much until there's a break in the high. Remember, the most important thing is market structure, and drawing trend lines does not add anything new that we can't see with market structure. Now that you understand trendline liquidity, don't dismiss the next form of liquidity, which is range liquidity. And this is the type of liquidity that forms around ranges, so around swing highs and swing lows, as there's likely to be a cluster of stop losses above and below. The market can sweep the lows and then have a push up, which then sweep the highs, clearing liquidity on both sides of the range. Breakout traders will also have buy stops above the high, expecting when the market breaks out to the upside to catch a buy. They will also have sell stops below the low, aiming to short the breakdown to the downside. Now that you understand range liquidity, let's look at a real-life chart example. As you can see, we have a clear range, and so there's naturally going to be a cluster of stop losses above the high of the range and below the low of the range. If institutions with big money want to fill in their positions, there can be a dump in price to trigger the stop losses of retail traders. So let's see what happened next. As you can see, price had a dump and swept the lows, triggering the stop losses of retail traders, allowing big money like institutions to fill in their positions. Remember, for every buyer, there has to be a seller. And once the lows were swept, we got a meaningful reversal and then a sweep of the highs. Then we got a further dump, sweeping the lows again. And markets are constantly pushing for the highs and the lows of the range, as liquidity is situated near major swing highs and lows. Consider getting in only after the liquidity has been swept with change in trend, because if you can't see the liquidity, then you'll become a part of it. Let's look at another example of range liquidity using this pound-dollar chart. As you can see, we have an earlier range forming, and there's buy-side liquidity to the upside, as breakout traders are aiming to catch a long upon breakout to the upside. There's also sell-side liquidity to the downside, as breakout traders are trying to short the breakdown of the range. And so naturally, there's a cluster of stop losses above and below the range, which acts as liquidity for the market to be attracted to. As you can see, we initially had this sweep of the highs, followed by a reversal. Let's see what happened next. We then had a sweep of the lows, followed by a reversal. We then yet again had another sweep of the highs, and so liquidity on both sides of the market was cleared before the market broke out of the range. We want to get in once the liquidity has been swept to reduce risk of being stopped out prematurely. But it's important not to trade purely based on liquidity, and observing the overall market trend is vital. Understanding core market concepts like market structure and order blocks take priority over liquidity, which should just be used as a confluence. Now that you've learned about liquidity, if you truly want to become a big player in the markets, you'll need to understand supply and demand. So I'll leave a video breaking that down in depth right here for you to go check out. Click it